Markets have had a bit of a wobble recently, and given high US valuations, I often hear from people that they're scared of investing large amounts of money given the current market environment. So is it better to invest your money in one big lump sum or to drip feed your money over a period of time in case markets do fall? In this video, we'll look at which strategy performs best, how that could change if you're cautious by nature or risk averse, how long to space out your drip feed if that is your decision to go that way, and then finally how to overcome your fear of investing. This video is sponsored by Freetrade, the commission-free investment platform which is revolutionizing the world of investing in the UK market. So which strategy performs best, lump sum investing or drip feed investing? Now, while there's no ambiguity about the term lump sum investing, almost everyone seems to understand that. In the case of drip feed investing, that comes under various names. Some people call it cost averaging, and sometimes you prepend the currency. So it could be dollar cost averaging or pound cost averaging. But the idea is exactly the same, which is that instead of taking, say, £100,000 and investing it on day one, you space that £100,000 over some period of time. You split it into smaller payments, equal payments usually, and then drip feed it, say, month by month. So that the price that you pay for whatever you're investing into will be the price average over that drip feed period. And Vanguard over the years has published various reports about this to see which strategy works best, and diagrammatically you can see the difference between the two strategies here. So either you put the money in on day one, that's the top green bar that you can see here, or the alternative would be to space out that lump sum over 3 equal payments in the first 3 months of the period. And then from that point onwards, from month 3, you remain fully invested. And then what you can do is to compare the strategies to see which one gives you the best return. Now, intuitively, because stock markets tend to trend upwards over time, it's usually the case that if you hold money back from the market, it usually leads to underperformance, unless you're just about to see a market crash. Unfortunately, we never know when those crashes will occur. It's not when valuations are high, they often stay high. There is no reliable indicator of when markets are about to tumble. So make no mistake, if you are going to choose drip feeding, it is a form of market timing, and also it usually leads to underperformance. And in Vanguard's comparison, they looked at the MSCI World Index, this is a developed market index, over the period from 1976 to 2022. And what they found was that if you do that comparison, drip feed versus lump sum, 2/3 of the time the lump sum investing strategy is better. The times when it underperforms, of course, are the ones in which stock markets fall just after you've invested the lump sum. And also, they don't recover. The drip feed strategy works best when you get a tumble in the first 3 months, and then you can buy at a very depressed price, and then the price recovers towards the end of the 12-month period. They also compared cost averaging with a cash investment using T-bills as the comparison. And in this case, they found that cost averaging was better than a cash investment, and that outperformance was about 69% of the time. And lump sum investing into the equity market also outperformed about 70% of the time. So this is just a confirmation of the fact that stocks usually outperform bonds and they usually outperform cash. Over short periods of time, that may not be true. That was the 1/3 of cases that we can see here. But over the long term, it really doesn't make much difference. So this is really just about your psychology and minimizing regret. But what I do hear from people time and time again, you can call this Roman's rule, is that if they do put a large sum of money into the market, you can almost guarantee that it's going to fall over the short term. You're super sensitive about losses, you're checking every minute, and that's usually a bad thing to do. But if you are going to be investing over the long term, drip feeding or lump sum investing will not make a huge difference. Now, would the result be different if instead of investing 100% into stocks at the end of the period, we end up with, say, a 60-40 stocks bonds portfolio or a 40% stocks, 60% bonds portfolio? It turns out that it doesn't make a huge difference. It's still the case that you're usually better off lump sum investing. If you look at the 50th percentile in this diagram next to me, you can see that the dollar cost averaging usually gives you a smaller wealth at the end of the period. Now, in the cases where markets do fall sharply, then it is the case that dollar cost averaging will usually give you a better outcome. But if you look at the actual numbers, and the row to look at is the 5th percentile, that's the bottom row of data, you'll see that the difference is actually quite small in monetary terms. Whereas if you look at the 95th percentile, these are the good outcomes, the difference is quite significant and in favour of lump sum investing. Now, people are often surprised that I'm a cautious investor myself. And if that's the case, if you are cautious or risk averse, how does that change things? So this is not just about economics and which strategy is numerically best in backtests. It's about your psychology and building a portfolio that you can live with. There's no point investing if you're not going to be sleeping at night or if you're having arguments with your partner about losing money. A portfolio is a really important life choice, and it's got to suit your psychology. So if the only way in which you can force yourself to climb what's called the wall of worry and invest your money into risky investments is to drip feed, then I think it makes sense. And this is how I overcame my fear of investing 100% in a global equity index. I drip fed over a 2-year period, and by that approach, I could actually overcome my fear. Now, what works for me may not work for you, but I would strongly recommend that you come up with a plan before you start a drip feed, if that's what you decide to do. It doesn't have to be a complex plan. You first of all have to decide the period over which you'll be drip feeding, and then completely keep to that plan. By the end of that period, you must be invested in whatever portfolio you decide on. It doesn't have to be 100% stocks. It could be a combination of bonds, stocks, commodities, whatever. But by forcing yourself to meet a certain portfolio by a certain deadline, you avoid certain bad behavior, which is to withhold money if conditions change, if markets start moving around. So maybe a second thing to consider would be that you should actually accelerate your drip feed if markets fall. That makes absolute sense, because if you buy things when they're at a reduced price, it increases your long-term return. So as part of your plan, your drip feed plan, you should put something along the following lines. If markets fall by X% from their initial price over the drip feed period, I'll accelerate my drip feed, or maybe just shorten the drip feed period. Alternatively, you could say, if valuations fall below a certain level, I'll accelerate my drip feed. Personally, I think that would make more sense, because it's really about being opportunistic and buying stocks if they become cheap. And then the third and really important rule is, I will not deviate from this schedule. It's tempting if you see the calendar reminder saying buy stocks today, and you see markets falling, to think, well, if I delay by a day, they'll be even cheaper. No, don't do that, because usually what happens is that markets snap back. So create a fixed schedule, maybe automate it. A lot of platforms allow you to do that nowadays, and stick with it. And never step back from the drip feed, only accelerate it. And that way you'll probably come out with a better overall total return. Now, if the trigger for accelerating your drip feed is based on valuation, it probably makes sense to look at US valuations, because if you're investing into a global index fund, a lot of that is going to be US stocks anyway, and US valuation data is much easier to come by. So personally, I use the FactSet Earnings Insight report that comes out every week, and you can find it really easily by Googling FactSet Global Insight. And roughly on page 30, sometimes page 33 of the report, you'll find this graph. It's a forward 12-month price to earnings ratio for the S&P 500. So currently it's around 20 times forward earnings. You can see the 5-year average is the dashed green line, the 10-year average is the dashed blue line. And you could say, well, if we cross the 10-year average, that's when I'm going to go all in, or that's when I'll accelerate my drip feed by X months, such that my monthly installments will get much bigger. However you choose to do it, though, stick with it and make sure that you write down your plan. In order to stay accountable, maybe get your partner or your friends to ensure that you do stick with it. Today's video is sponsored by Freetrade, the UK commission-free platform that's revolutionising the world of investing in the UK market. Freetrade offers you over 6,100 US, UK and European stocks, ETFs and investment trusts. With over 1.5 million users on board and having won the best online trading platform at the British Bank Awards 5 years in a row, they're a well-trusted trading platform. With Freetrade, investors have the opportunity to manage their investments in a tax-efficient way by opening a stocks and shares ISA. For those looking to consolidate their retirement savings, Freetrade offers a self-invested personal pension or SIP, so you can bring all your old pensions under one roof. Freetrade stands out as the only UK platform to give you access to UK Treasury bills that start from a minimum investment of £50. These instruments are backed by the UK government and so are widely regarded as a low-risk investment. As I make this video in April 2024, these instruments offer a yield to maturity that surpasses the current inflation rate. But that's not all. Freetrade is offering our YouTube audience a free share worth between £10 and £100. All you need to do is to join the platform and fund your account with at least £50. The free share will be added to your account within 7 to 10 days of funding. Ready to claim your free share? Head over to freetrade.io/PensionCraft to benefit from this offer. You can also find this link in the description of the video. Another choice if you do decide to go down the drip feed route is how long to drip feed for. Now, because we know that stocks drift upwards most of the time, you can probably guess that the longer you hold money back, the more you'll underperform on average. And indeed, when Vanguard did a simulation approach where they simulated the return you'd get under various scenarios, either they did the 3-month drip feed and then compared total wealth after a year, which is what we saw previously, or they split the capital into 6 monthly investments and compared with the lump sum approach. And what they noticed was that the underperformance of the drip feed approach was greater the greater the period that the drip feed occurred for. So that was the central case, the median case. In the 95th percentile, when markets surged upwards, it was even more noticeable how much drip feed underperformed lump sum. However, if markets did tank in their simulations, then the drip feed approach lost less if you drip feed over a longer period of time, the 6-month approach, rather than the 3-month, relative to the lump sum. But make no mistake, the probabilities here are tilted towards markets going up. So really my focus would be on that median case, not the 5th percentile, which is a very bad outcome. That tends to happen very infrequently. So if you are going to be drip feeding, then it's probably best not to drip feed over a very long period of time. I chose 2 years, it was far too long. Usually 6 months to 12 months is plenty of time to overcome your fear of investing, and usually it doesn't underperform much. So how can we overcome our fear of investing? Now, there's not just one way to do this. Drip feeding is just one approach. You've got to find what works for you in order to be able to invest in a portfolio that you're happy with. One rule, which I think is pretty simple and which works very well for many people I've spoken to, is just not to look. Don't look at your portfolio. If you're checking more than once a day or even daily, that's probably too much. Looking monthly is probably okay, or not looking at all is probably fine. But let's be honest, all of us do look. It's just tempting to do that, particularly when we've just invested. So if that's not the approach, what else could work? Now, over the years, I made many videos about investing, and I started to absorb the data that I was using in the videos, and the statistics were very comforting to me. Now, you'll often hear people talking about volatility. What does that mean? Well, it's really important to understand it because it allows you to calibrate your expectations about market moves and how much your investments should change over time. If we invest in a global equity index, a global stock index like the MSCI ACWI index, then our tracker will pick up the volatility from that investment. And that's roughly 15% per year. What does that mean in practice? Well, let's say that we've got £100,000 invested and the volatility is 15%. Well, that means that a £15,000 movement, either up or down, is absolutely normal. You wouldn't think twice about it, or at least you shouldn't. In fact, a 2 standard deviation move is fairly common. So a 30k upwards or downwards movement shouldn't shock you. Now a 3 standard deviation move would be shocking, but that's fairly unusual. But usually we don't think in annual terms, we think in monthly terms, and the monthly change, if the volatility is 15% and you've got 100k invested, would be about £4,300 per month. That would be a 1 standard deviation move. And the daily move would be around £1,000, actually about £940 up or down. So when you first create this portfolio, it can be pretty shocking when you see £1,000 move downwards. But if the volatility is 15%, that's completely normal. So use this volatility knowledge to scale up. So if you've got £200,000, you just double these numbers. And then you'll know when to be surprised by a market move. But more importantly, you'll know when not to be surprised. Another point is about investing based on the worst outcome. Most of the time, markets don't crash. And when stock markets do crash, it's usually fairly short-lived. So what is the probability of a crash? Well, I find the 2-6-16 rule quite useful. Falls of 10% or more happen with a probability of about 16%. 20% or more, that's a market correction. That happens with a probability of about 6% over a 1-year period. But a fall of 30% or more is very rare. That only happens 2% of the time over a 1-year period. And yet that's the way people think when they invest in stocks, as if it's something like gambling and a crash is actually quite likely. Well, actually, it's not. And even if markets do fall from their previous all-time high, they usually recover that high fairly quickly. In fact, the median recovery time to the previous all-time high is just 2 months for the S&P 500. Yes, there have been long drawdown periods of over a decade when you look at total real return, but that is very unusual. In summary then, don't be under any illusions. Drip feeding is market timing, and that's generally a bad thing. Holding money back from the market usually underperforms. And depending on what platform you use, if it does charge a commission on your trades, then you will end up paying more if you space your investments out over time into multiple transactions. One lump sum investment usually costs less. But if it is the case that you're risk averse, such as I am, then it may make sense to drip feed, if that's how you can overcome your fear of investing. And one benefit of the drip feed approach is that it is more flexible. If it is the case that markets tank, then you'll be able to make use of those cheaper opportunities and probably increase your return over the long term. But for most of us, we don't choose when we receive money. If we're simply earning money and saving it as we go, then drip feeding is the natural way to invest. I think this lump sum versus drip feed approach only really applies if we receive a large sum of money. If we sold a business, if we've received an inheritance, for example, then we start to think about lump sum versus drip feed much more carefully. Now, don't forget our offer from Freetrade, who's sponsoring today's video. To learn more about that, just go to freetrade.io/PensionCraft or use the link in the description below. And, as always, thank you for listening.